A very good evening and welcome all to this session hosted by Taxmann. Over the next 45 to 50 minutes, we will cover some of the recent significant developments in financial reporting. We will start with the changes or the amendments to supplier finance, something that has been the talking point amongst many, given its significant kind of uptake in recent times. We will then move on to Pillar 2. As some of you will be aware, Pillar 2 has been on the agenda for most companies to whom Pillar 2 applies, and what are its accounting implications. And lastly, a couple of other key amendments that have or developments that have taken place relating to the reporting pace. So I have the pleasure of having the subject matter expert Archana, who will kind of lead this discussion. I will come back in to describe a little bit more about Pillar 2. But over to you, Archana, on the to start with on the supplier finance.
Thank you, Utkarsh, and good evening, everyone, and welcome to the call. As Utkarsh has already laid out, a first topic for discussion is supply finance arrangements. But before I really get into the technical part of it, just from an overall context, the developments that we will discuss today in the call, they're largely similar in terms of be it IFRS or Ind AS, though their status may differ right now. So when I will discuss this, you can take it that these are relevant both from an IFRS perspective and Ind AS. Frankly, the amendments are actually all applicable, or when I say applicable, they've all been finalized, and they're finalized in IFRS. As far as Ind AS is concerned, some of them are still in the exposure draft phase. But when I'm going to therefore discuss it, I will also take the liberty of taking inputs or the understanding as to what drove these amendments in IFRS, because that becomes the basis for us. So as you're aware, Ind AS are based on IFRS standards issued by IASB. And as part of the convergence with those standards, the Ind AS also get issued or revised corresponding to them. And most of the changes that developments we're going to discuss today represent developments in Ind AS based on the developments which have taken in IFRS. So the first topic, which is the supplier finance arrangement, these are proposed amendments to Ind AS 7 and Ind AS 107. These correspond to amendments in IAS 7 and IFRS 7, which have been issued by IASB. So in IAS 7 and IFRS 7, those amendments, like I said, are final. In India, this is currently at an exposure draft phase. It's with MCA, we understand that, and hopefully it'll get issued soon. In terms of the applicability, the date of applicability, if we can just move to the next slide, please, Kriti. Just go to next slide. Yeah, next one. So in terms of the amendments, the effective date, as far as Ind AS is concerned, these are proposed to be effective for reporting periods commencing on or after 1st April 2024, and will require a company to give additional disclosures. Whereas in IFRS, like I said, these are already finalized and they will apply for annual reporting periods commencing on or after 1st of January 2024, with early application being permitted. Now, before we really get into the details of the amendments, it may be good to understand why IASB has really made these. So when you look at the history, after a series of unexpected bankruptcies, an investor actually approached the IFRS Interpretations Committee, which is what we call IFRIC, to clarify the accounting and disclosure requirements for the supplier finance arrangements. The committee affirmed the requirements existed, but it also suggested that the IASB may consider some additional disclosure requirements. So there is actually an IFRIC agenda decision, an earlier IFRIC agenda decision, which talks about supplier finance arrangements when you look at its classification and presentation in financial statements and cash flow. So basis the IFRIC Interpretations Committee inputs, the IASB started a project to develop the amendments The intention, of course, is to improve the transparency of information regarding these arrangements and the effect these arrangements have on a company's financial statements. So effectively, the amendments seek to respond to the investor feedback, which said that without targeted amendments to disclosure requirements, they may not be able to obtain from financial statements some of the information that they felt they needed to understand the effects of these arrangements. Like I said earlier, there is an IFRIC agenda decision which was published in December 2020. It sets out the requirements in the standards that are applicable to supplier finance arrangements. So, when we discuss the development today, like I said, these are changes or proposed amendments to Ind AS 7, which is cash flow, and Ind AS 107. This does not really discuss whether these arrangements should be, how these arrangements should be presented in the balance sheet, in the sense, should it be trade payable, finance, what kind of a financial liability this is. So you may still refer to the IFRIC agenda decision, which does provide some useful guidance in that regard. These amendments complement, therefore, the disclosure requirements which were set out in that agenda decision. So in the session today, we will provide a very brief overview of what a supplier finance arrangement is and the related proposed amendments to Ind AS. Now, the amendments apply to a supplier finance arrangement that has all of the characteristics that I'm going to mention. First, a finance provider pays amount that a company owes to its supplier. So if you'll see on the diagram that we have on the slide, the company has purchased goods or services from the supplier. However, what it does is it enters into an arrangement with the finance provider where the finance provider will make the payment to the supplier. The company agrees under the terms and conditions of the arrangement to pay this amount on the same date or the later date. Then its suppliers are paid. Effectively, what happens is the company is provided with an extended payment term, or either the company will get an extended payment term or the supplier will benefit from an early payment terms compared to the related invoice payment due date. Now, the supplier finance arrangements which are within the scope of this amendment do not cover arrangements for financing receivables or for inventory. So if an arrangement has the characteristics of a supplier finance arrangement that meets the criteria set out in the amendments, then it will be within the scope. Quite often there are, different terminologies used. Some use the terminology reverse factoring or supply chain finance. The important thing would be whether this criteria is met. The labeling or the nomenclature would not be relevant. Now, because there are a range of programs that can qualify as a supply finance arrangement, it is helpful, like I said, to understand a brief description of what a typical arrangement may look like. So in the example which is there on the slide, let's say a company has purchased goods or services from a supplier. Let's say the company would have usually, let's say, a credit period of 30 days, for example, to make the payment to the supplier. In supplier financing program, the purchasing company could agree to pay a financial institution at 30 days. But what happens is the supplier can earlier collect the money. It can access the funds from the financial institution earlier, say within 15 days, by taking a small discount to fair value. So effectively, the supplier in this example that I'm taking gets an early access to the funds, right? Now, let's say the company, while I have a 30-day credit period, I may, typically maybe paying my bills within 15 days. Now, what happens is through this arrangement, the supplier takes the funds from the financial institution. I, as the company, still, let's say now decide to pay at the end of 30 days to the financial institution. So I also get an additional 15-day window, the cash frees up for that period, and even the supplier benefits. Now, you may think that this would be a small change in working capital, but if done meaningfully and done with a large number of its suppliers, then it can actually be quite meaningful. So, and this also has the benefit because quite often we've seen that this an arrangement may be a good deal for the supplier, which could be a small company with no credit rating or let's say poor credit terms. And why does this arrangement help? Because this arrangement helps because the company's credit rating is used, and it is not the supplier's credit rating which determines the discount which is attached to accessing the funds earlier. So while the supplier may pay the interest, it still benefits from the credit rating of the company in this regard. So overall, the effect on the working capital in such a arrangement tends to become quite meaningful. The amendment also provides some examples of arrangements which may not be, which are not supplier finance arrangements. So one example is an arrangement which is solely credit enhancements for the company. So for example, financial guarantees, including letters of credit used as guarantees. Another example which is not covered is an instrument which is used by the company to settle directly with the supplier. So for example, the company uses a credit card to settle the amount owed to the supplier and then will pay finally. It will have an obligation to pay to the issuing bank. So these are arrangements which are not within the scope. So if we can just move on to the next slide, please. Yeah. Now, what are the disclosure objectives? What are the amendments seeking to really address? I did talk about the investor feedback earlier, and these amendments were developed to satisfy two primary objectives. One is of IAS 7 or Ind AS 7, and the other is of IFRS 7 or corresponding Ind AS 107. The first one is to assess how supplier finance arrangement affects a company's liabilities and cash flows, because investors want to understand the amount of financial liabilities that are part of the supplier finance arrangement and the effect of the arrangements on the financial statements. Secondly, they also want to understand the effect of supplier finance arrangements on the company's exposure to liquidity risk and how the company might be affected if the arrangements were no longer available to it. So these are some of the investors' demand or the feedback and the objectives which the amendments seek to address. Let's move on to the next slide. Now, this slide actually lists out the proposed disclosures under Ind AS 7. And like I said, they are corresponding under IAS 7. What I'm going to do is I'm going to go between this and the next slide. I will take each disclosure, and then on the next slide, we have an illustrative example. We'll try and see how each requirement is met. So let's look at the first disclosure requirement. The first disclosure requirement, if you see, it says the entity is required to disclose in aggregate. So you don't have to give these disclosures for individual arrangement, but you can give it in aggregate. Now, while the standard permits disclosures in aggregate, it also says that you need to make these disclosures separately if the terms and conditions for arrangements are dissimilar. So let's move to the next slide and then we'll come back here. So if you'll see in this one at the top in no text, we've got the entity entered into arrangements with the following terms and conditions type A and B. So if there are two, then you will actually give separate qualitative disclosures of each of these. Now let's go back. The next disclosure is that a company is required to disclose the carrying amount and the associated line item of the financial liability that are part of this arrangement. So let's just move to basically here we are going to show the size of the company's supplier finance arrangements, and it will also help the users to connect the information back to the face of the balance sheet. So let's go to the next slide and we'll come back again. Let's see. Now, if you see here, carrying amount, we've said in this case, the company has overall, if you see in the year ended 20x2, the company has 2,500 of financial liabilities total that were part of the supplier finance arrangements, of which 1,500 has been presented in trade and other payables and 1,000 has been presented in finance payables. Okay, so this in a way gives you an idea of what is my total and which line item of the financial statement it has. So 1,500 and 1,000, that's the breakup. Okay, now, sorry, can we go back again and we'll come? The next one is that the company is required to disclose the carrying amount and associated line item of financial liabilities for which the suppliers have already received payment. Now, this effectively, the objective of this disclosure is to enable users and users of financial statements to analyze the company's liabilities and their effect on the operating and financing cash flows, and also then to understand the effect of these arrangements on the exposure to liquidity risk, so that they can understand how the company would be affected if the arrangement was no longer available to it. So let's see how this is presented. Now, if you see here, we said 2,500, 1,500 was in trade and other payables. Now we are showing out of 1,500, 1,050 has already been paid by the financial institution to the supplier. So I still need to pay 1,500, but this in a way tells you that out of 1,500, how much the financial institution has already paid my supplier. And so this again, the split is required separately because, like I said, the disclosure requires the associated line item in which it is presented. The next disclosure, let's go back. The next disclosure is of the range of payment due dates for financial liabilities that are part of supplier finance arrangements and comparable trade payables of companies that are not. So effectively, it gives you an idea as to what my range of payment would be if I had not entered. And if I've entered, it just helps you give a comparison and, you know, what is where the benefit has been. So if you move to the next slide, if you see, there is a range given, liabilities that are part of the arrangement. Let's say the days after which payment is made is after the invoice date is 85 to 90. Whereas if you had not availed of the supplier finance arrangement, the payment due date is usually 60 to 70. So it in a way helps you get a comparison and the impact on liquidity. The last is that, one more thing, if I may just add, is that if these ranges of payment due dates are very wide, right now we've not taken it to be too wide in this example, but if it is very wide, then a company is required to even give explanatory information about those ranges, or you can even give stratified ranges of payment due dates. So you give more ranges in that sense. The last requirement, disclosure requirement, is that the company is also required to disclose the type and effect of non-cash changes in the carrying amount of financial liabilities that are part of these arrangements. So let's just understand this. So under some supplier finance arrangement, trade payables retain their classification in the balance sheet after they are considered as part of the arrangement. In some other arrangements, let's say the company changes the classification. Once the payment is made by the financial institution, let's say the company reclassifies the trade payable. Let me not say reclassify, it de-recognizes the trade payable and recognizes a finance payable instead, right? Now, the feedback from the investors suggested that knowing when this change in classification has occurred is essential in analyzing both the liabilities and cash flow. The change in classification could result in a non-cash transfer in the statement of cash flow, an operating cash inflow when the trade payable is initially created, followed by a financing cash outflow when the new finance payable is paid. Now, this non-cash transfer can have implications for investor analysis of cash flows, and that is where the requirement of disclosure came in. So these are broadly, if you see from an Ind AS 7 or IS 7, what I don't have on the slide is I've been talking about the liquidity risk information, and the amendment which is being made to proposed amendment to Ind AS 107 is on the liquidity risk. So a company is also required to provide liquidity risk information about its supplier finance arrangement. And the feedback that was received from the investors indicated that it is important for them to understand if a company's use of supplier finance arrangements has concentrated the company's liability with one or a few finance providers. If, let's say, the finance providers withdraw one or more arrangements during times of financial stress, which could even happen at a short notice, then that withdrawal could increase pressure on the company's cash flow and impact its ability to settle liabilities when they become due. So that's the objective. Let's move further. So let's go to the next slide. So we've already seen this, and the last slide is on the effective date and transition, which I've already mentioned. So the effective date in India is it's proposed to be first of accounting periods commencing on or after 1st April 24. As far as IFRS is concerned, this is accounting periods commencing on or after 1st January 24. There are some exemptions in terms of the comparatives and interim. So if I look at the comparative, an entity is not required to disclose the comparative information in the first year it applies these amendments. You also, when you apply a new accounting standard, typically you also have to give an opening balance sheet. So those requirements will not really come in. In terms of the balances as at 1st April 2024, again, there is an exemption available. In terms of interim, an entity is not required to disclose the interim information in the interim periods. So you straight away, the first time you make the disclosure is in the first annual reporting period in which an entity will apply these amendments. So many exemptions available in terms of its transition. So that's what we have as far as supplier finance arrangement is concerned. Utkarsh, I'm going to hand this back to you.
Thanks, Archana. I think that was quite insightful. And the audience, for any questions that you do have, please do post it in the Q&A box, and we will try to address them towards the end of the webinar. Moving on to the next topic, which is Pillar 2. I mentioned this is a topic that's been discussed in tax circles across the globe. It is probably the single biggest development in international tax over the past many years. And what we will do is that we will divide this piece into two parts. We'll have a bit of a brief on technicals of Pillar 2 at a very high level. And then Archana will take us through the accounting implications for Pillar 2. If we move on to the next slide, as a base level, Pillar 2 applies to multinational groups. That means that you need to operate in country outside of your home country. Correct? That's the first test. Second is your global revenues should exceed 750 million euros in any 2 fiscal years out of the prior 4 fiscal years. This is the same test as what is applicable for CBCR reporting, which is there. Now, what's the base of Pillar 2? Essentially, what Pillar 2 or the OECD Pillar 2 initiative seeks to achieve is that every multinational group that operates across the globe should pay a minimum of 15% tax in every jurisdiction in which they operate. That's the headline for Pillar 2. Having said that, its interpretation as well as its implementation is extremely complex. Rules comprise of 2 main rules, which is the income inclusion rule or the main rule, and the backstop rule, which is the undertax payment rule or the UTPR as is referred to. And lastly, there is also what is something called as QDMTT or Qualified Domestic Minimum Top-Up Tax, which every local country may legislate. So what do these 3 rules really mean? Income inclusion rule, as I said, that large multinational groups pay a minimum level of tax in each country in which they operate. If there is a shortfall, right, of the tax, which is their ETR as calculated for Pillar 2 purposes is lower than 15%, the difference effectively is to be paid at the parent level, and that is the income inclusion rule. Right? The parent entity needs to pay that tax. There is a backstop rule or something which is called as UTPR, which means that if at the parent level, the jurisdiction in which the parent is based does not enact any laws giving powers to its local authorities to collect that revenue, then other entities in the group that have enacted this undertax payment rule or UTPR will get a right to collect those taxes, and there is a computation mechanism that is given for that. Lastly, what's domestic top-up tax or QDMTT? Which means that every jurisdiction, if they legislate and bring in laws to collect this top-up tax, they will have the first right to collect the tax differential. In other words, say an organization's ETR comes to 13% vis-a-vis the 15%, which is the minimum requirement. The difference of 2%, if the local country has enacted QDMTT or local rules, the differential of 2% will have to be paid in that country itself, and not the liability will not go to the parent entity or nor to any other entity within the group. So these are basically the three main rules that are there. Of course, there are multiple other complexities involved in calculating what's top-up tax, calculating what is ETR, calculating what will likely be QDMTT, and also how do you go about calculating it first at an entity level, then at a jurisdiction level. So we just do a very high level assessment of that. If we can move to the next slide. Move to the next slide, please. Thank you. So if you see, what we've done here is just given a high level calculation mechanism. First, you need to identify entities that are within the scope. You will see on the left-hand side that there are certain entities or organizations that are excluded from Pillar 2. So first, you need to identify groups within the scope and location of each constituent entity. Then you need to determine what is the globe income. Global income is again something that you need to compute in a defined manner. And all of this thing is given in the OECD rules. So you determine the income of each of the constituent entities, and you determine what's the tax attributable to each of the constituent entities, which is nothing but covered tax. After that, you calculate their ETR or their effective tax rate at a jurisdiction level, which means that if you have three entities in a particular country, you need to blend all of this into one, which is called as jurisdictional blending. And at a jurisdiction level, you need to come up with a ETR for that particular jurisdiction. So it is quite likely or maybe possible that one entity may have an ETR that exceeds, say, 22%, and the other one may have an ETR of, say, 12 or 13%. But when you blend, if both those entities are in the same country, when you do jurisdictional blending, your ETR may be higher than 15%, in which case there will be no top-up tax liability. Now, in case where there is a top-up tax, you obviously need to apply the income inclusion rules and the UTPR rules as may be legislated. And lastly, if there are any additional rules that apply because of various acquisitions, hive-offs, or anything that have happened, you need to apply those rules. So we've tried to simplify it over here, but again, at the cost of repetition, what we've seen practically is that the rule set is fairly complex when you have to actually drill down and try and implement it. We can move to the next slide, please. Now here we've just given, I will not go through the slide in detail, but how do you compute top-up tax? And these are all terms that you will see, which Archana will also refer to. How do you compute top-up tax for a jurisdiction? It's what is the top-up tax percentage? Top-up tax percentage is nothing but the 15%, which is the minimum rate less the ETR. You multiply that by the excess profits. Again, excess profits, you need to compute it by net globe income minus substance-based income exclusions. You add what is any additional top-up tax and reduce what is domestic top-up tax or QDMTT. Now, it is likely that when a jurisdiction does implement QDMTT or qualified domestic minimum top-up tax, there will be nothing that will be, you will be required to pay outside of that country. There is a term that you will also often hear a lot of times in doing Pillar 2, which is what are covered taxes. And covered taxes is your tax expenditure. It also includes various items of deferred tax, what is to be included, what is to be excluded. There is detailed guidance available. There is also recognition to say that when you do have substance in an entity, but it is enjoying a certain lower tax rate because of any incentives that that particular country is offered. There is a substance-based income exclusion rule as well, where certain income to the extent of certain percentage of payroll and value of tangible assets will be excluded. So which means that even if you are in a country where there are certain tax exemptions that you might be enjoying, which reduces your ETR, but if there is adequate substance, there is certain income which will be excluded from the calculation of Pillar 2. Last, at the bottom of the screen, you will see this formula of what is jurisdictional ETR, which is your adjusted covered taxes for all constituent entities, which is divided by the net globe income. This gives you a jurisdictional ETR. And if this is less than 15%, then there will be applicability of top-up tax. If you move to the next slide, please. Just before I hand it over to Archana from an accounting and a disclosure perspective, it's important to recognize that there are safe harbors that have been prescribed by the OECD to say that if certain tests are met, right, and you do certain simplified calculations, you will be covered within the safe harbor, which means that there is no need to do any detailed Pillar 2 calculations. Now, why are safe harbors relevant? It's because if you deep dive into the Pillar 2 regulations, there are about 110 core data points that are required for multiple calculations per entity. Okay. And when you further drill down, you will come to around 200 odd data points that are required per entity to calculate their ETR and various other requirements under the Pillar 2 laws. Right? Now, to kind of avoid going through the whole detailed calculation, there is a safe harbor, and there are 3 tests for it, right? This is per entity that you need to apply. If you are meeting any of these tests, then you can apply for safe harbor, which is valid only for a period of 3 years, right? So first one is the de minimis test. Again, a lot of this data will be available from the CBCR filings, right? So de minimis test just says that if your total revenue is less than euro 10 million and profit or loss is less than euro 1 million, then you can say that you are in the smaller entity of the de minimis test, and hence safe harbor applies. There is an ETR test where there is a formula given which they call to calculate a simplified ETR. If that is equal to or greater than the transition rate is nothing but 15% for 23 and 24, 16% for 25, and 17% for 26. So if your ETR, simplified ETR as is calculated based on just a couple of data points, is higher than this transition rate, then clearly you can apply for safe harbors. The last one is the routine profit test. That is, if your income is equal or less than the substance-based income exclusion amount, which we just discussed, which means that if, say, your income is 100, right, and your substance-based income exclusion amount that it comes to is, say, 110 or 120, in which case also there will be nothing that will kind of become payable, which means you are definitely earning routine profits, and hence you can apply for safe harbors. Now, all of these workings do need to be done, and an organization needs to kind of figure out which jurisdictions will fall within the definition of safe harbor and which won't. The jurisdictions that do fall within safe harbors, you'll have to do a kind of a lesser degree of working, but those that do not fall within the ambit of safe harbor, you would need to do full working to determine what is the entity level ETR and then the jurisdictional level ETR. Now, I'll hand it over now to Archana to tell us about some of the accounting disclosure and the reporting requirements from a Pillar 2 standpoint.
Thanks, Utkarsh. Can we move to the next slide, please? So as jurisdictions are preparing to amend their local tax laws to introduce the global minimum top-up tax in line with the globe model rules, stakeholders are questioning as to how to account for these changes. Particularly, one of the questions which is coming up is whether the top-up tax is in the scope of the standard IAS 12 or the corresponding Ind AS 12? And if yes, then how do you account for its deferred tax implications? Now, top-up tax differs from income taxes that arise under traditional tax regimes because those are usually, the traditional income tax is usually based on the company's taxable profit. Here, top-up tax will arise if a group pays, let's say, insufficient income tax at a jurisdictional level. That's also where it can arise. So some of the accounting issues which are being raised is that, is top-up tax in the scope of the standard on income taxes? Do these rules create additional temporary difference? And if yes, how do you account for it? Does any adjustment need to be made or remeasurement needs to be done for any existing temporary differences? At what rate do you measure these deferred tax implications? So in May 23, the IASB issued amendments to IAS 12, wherein they amended the standard for following, for the reasons which is stated in the table on the right. One is to provide the timely relief for the affected entities. Second is to avoid diverse interpretations developing in practice. And thirdly, to improve the information which is provided to the users of financial statements before and after the legislation comes into effect. So the amendments, as you'll see from the slide, the table on the right, is that first, a mandatory temporary exception has been introduced for accounting for deferred taxes arising from the jurisdictional implementation of the Pillar 2 model rules. And the second is that the additional disclosure requirements have been introduced to help the users of financial statements better understand the entity's exposure to these taxes, and particularly before its effective date. The mandatory temporary exception applies immediately, and the remaining disclosure requirements will apply for accounting periods commencing on or after 1st of January 23, as far as IAS 12 is concerned. These will not apply to any interim periods ending on or before 31st December 23. As far as the Indian standards are concerned, similar changes which are similar to IAS 12 are being proposed in Ind AS 12 as well as AS 22. And therefore, disclosure requirements will be introduced, which will apply for annual reporting periods beginning on or after 1st of April 23, which is the current year itself. Like I said, no disclosure will be required in the interim periods. The only disclosure which will be required during the interim is the fact that the relief has been applied. So that disclosure will need to be made. Other than that, there would be no other implications as far as the interim periods are concerned. We understand this is still at the ICI level. So while the ASB is cleared and it's out as a draft, all of you would have seen it. I think this is still pending at an ICI council level, and then it'll move to the ministry for further approval. Let's move to the next slide. Now, so let's see what are the implications. So I've already spoken about the temporary exception, which will apply. And while that exception is temporary, it is a mandatory exception. So it will provide the entities with relief from accounting for deferred taxes in relation to this complex new tax legislation. However, to compensate for the fact that you'll get this relief and the financial statements will not really have the impact, certain disclosure requirements have been introduced. Now, let me also add that these standards do not include any sunset date for this temporary exception. Effectively, the regulators will monitor the implementation of these rules, and then they will determine as and when to kind of take further work on it and remove this exception. But right now, there is no sunset date. I also discussed earlier that you have to, at a minimum, disclose the fact that the company has availed the relief, so that will come. Now, before the legislation is in effect, the amendments require that for the period in which the Pillar 2 legislation is substantively enacted but not yet effective, then disclosure has to be made of the known or reasonably estimable information that helps users of financial statements understand the entity's exposure arising from these taxes. And to comply with these requirements, an entity can disclose qualitative and quantitative information about its exposure to the Pillar 2 income taxes at the end of the reporting period. So, for example, if you look at on the slide, the qualitative information will include how the entity is affected by these legislation and the main jurisdiction in which the exposure might exist. Quantitative disclosures will include proportion of profits that may be subject to Pillar 2 income taxes and the effective tax rate applicable to those profits, or how this effective tax rate would have changed. Now, if when you look at this information, it does not need to reflect all the specific requirements of the legislation. It can be provided in the form of an indicative range, and and if the information for whatever reason is not known or cannot be reasonably estimated at the reporting date, then the entity is required to disclose a statement to that effect and the information about its progress in assessing the exposure. Once the top-up tax is effective, then the entity is required to separately disclose its current tax expense, which is related to Pillar 2 income taxes. And this will help the users of financial statements understand the relative level of those taxes. Now, one interesting bit which I may just add here, and frankly, we did have quite a bit of discussion in the Institute on this, and we also went back to the IASB, is that can we presume that in India, or let's say in any jurisdiction by nature, that the Pillar 2 top-up tax will be considered to be an income tax in the scope of the standard IAS 12 or Ind AS 12. Now, if you see the way the standard is drafted in the basis, the IASB has not provided clarification on this. So effectively, the standard does not let you to presume, it does not permit that you can presume that this will necessarily be within the scope of the standard. An entity will be required to apply judgment to determine which top-up taxes it considers to be income taxes in the entity's circumstances. So while intuitively it seems to be within the scope of the standard, like I said, the standard, this is not a presumption, but will need to be considered after looking at how the law is drafted in the jurisdiction. In terms of applicability, I've already spoken about the applicability. And yeah, so in terms of the impact, I think there is entities will need to get ready to provide the additional disclosures required by the amendments. And so they will need to start making preparations to provide these qualitative and quantitative information. Entities will also need to monitor the developments around the implementation and the enactment of the Pillar 2 model rules in the relevant jurisdiction. And also to consider whether they have appropriate processes and procedures to obtain information which is necessary to present the disclosures as required by the standard. Yeah, and that's largely it. So I'm going to hand this back to you, Utkarsh.
Thanks, Archana. Certainly, a lot of developments happening on the Pillar 2 front, both on the legislation itself as well as the reporting requirements. Just a couple of weeks back, we had the STTR rules kind of opened up for signature as part of MLI. We have, as we speak, about 40 to 45 countries that have in some form given guidance on Pillar 2, whether as final legislation or draft, and more are expected. So something that's certainly going to pick up a lot in the coming months. If you move on to the next slide, we will now be discussing some of the amendments in Ind AS. The next slide, please. In the interest of time, we will cover just the first two ones, which is disclosure of accounting policies, which is very fundamental, and there is a paradigm shift right from it being significant to being material. And Archana will touch upon that. And secondly, we will be discussing the definition of accounting estimates and what is the requirement there. So, Archana, over to you to cover these two important developments.
The first one I'm going to take is the first I'm going to take is on the disclosure of accounting policy. So if we can move to the next slide. Now, this one is actually very interesting. If you like I said in the beginning, these amendments have been finalized, so these are very much applicable now. Now, if you look at the background to this, as to why this was introduced, and again we go back to why IASB made these amendments. The IASB issued these amendments in 2021, in which it provides guidance and examples to help entities apply the materiality judgment to accounting policy disclosures. Now, these amendments aim to actually help entities provide accounting policy disclosures that are more useful by replacing the requirements for entities to disclose their significant accounting policies with a requirement to disclose their material accounting policies. And the second bit is that the amendments also add guidance on how entities apply the concept of materiality in making decisions about accounting policy disclosures. Now, like I said, the reason they came in is that materiality as a term is well understood. But when you talk about significant is a term which has not been really defined in the standard. So effectively, there was lack of clarity as to how do you really interpret this term significant. And it was felt that since materiality is a well understood concept, maybe that is how this can be bridged. So that is where the requirement to disclose significant accounting policies has been replaced with material accounting policies. And there are corresponding amendments, like I said, even in IAS 1. Now, when we say material accounting policy, what is the criteria? So an accounting policy information is material if, when considered together with other information included in an entity's financial statement, it can reasonably be expected to influence decisions that the primary users of general purpose financial statements make on the basis of those financial statements. So that's the definition, general definition of materiality. I mean, which, if you see, the two are similar, right? So, so that definition, in that sense, it's easier to understand because it is consistent with the materiality definition, which is generally applied for preparation of financial statements. In terms of the application as to how do you really apply this, the board has added guidance to help entities determine when the information is material and therefore when does it require disclosure. When making this assessment of materiality, entities will need to consider both the size of the transaction and other events or conditions and the nature of and their nature as well. So this is what we typically do. Size and nature both need to be considered. In Ind AS, the amendments are being made only to Ind AS 1. But when you look at IFRS, apart from amendments being made to IAS 1, there is also some amendment which is being made to the practice statement on materiality. So that's in a way complementary. It has some additional examples, and even from the context of Ind AS 1, if you would like to see how this, there's some good examples there. So users can even refer to the amended or the revised practice statement to see how this would be applied. Now, if I was to just quickly go through some of the key points which are coming from the guidance, accounting policy information related to immaterial transactions, other events or conditions is self-immaterial, and therefore such information need not be disclosed. Accounting policy information can be material because of its nature, even if the amounts are immaterial. So I did speak about size and nature, or it could be size or nature. Not all accounting policy information relating to material transactions or other events or conditions is necessarily material itself. Like I mentioned in terms of the definition, accounting policy information will be material if users would need it to understand other material information within the financial statements. If an entity does disclose, while you're not required to disclose information which is immaterial, but let's say a company does choose to disclose it, it's not prohibited, but the rider is that such information should not obscure material accounting policy information. And the fact that an accounting policy information is immaterial does not mean that you will not make the disclosures which are there, related disclosures which are there in the related standards. So These are, the board has also clarified that, I'll go to the next slide, but just to mention here, it has also given some examples of circumstances in which an entity is likely to consider the accounting policy to be material, but that would not be really exhaustive. So just very quickly, like I said, term significant accounting policy replaced by material. What is material accounting policy? For that, the definition's been given, which is consistent with materiality concept in general, certain application provided, and this is converged with IFRS, and amendments will apply to annual reporting periods commencing on or after 1st April 23 as far as India is concerned. Let's move to the next slide. So these are some of the examples in which an entity is likely to consider an accounting policy to be material. So let's say if there is a change because of a material change to the information, let's say the index gives you multiple choices and you have selected a particular accounting policy choice, or let's say there is no specific accounting given in the standard, but you have applied, the hierarchy in India, say, to select and to draft an accounting policy. Or maybe the accounting policy requires significant judgments or assumptions, or maybe it is just simply very, very complex and requires disclosure to understand it. So there are some examples which are given. If I may just add here that the whole objective is also that the regulators do not want, very standardized information just to be given. So if you see, quite often, when you go through the accounting policies are usually, I won't say all, but quite often they're duplicating or just summarizing the requirements of the IFRS. So the board acknowledged that generally such information where you're just duplicating will be less useful to the users than the entity-specific accounting policy information. However, they also acknowledge that standardized accounting policy information may be needed, in certain circumstances. And in those circumstances, standardized accounting policy information, if material, should be disclosed. So the point I'm trying to make is that as per the revised requirements, generally, it will be more useful to provide information which reflects an entity's own specific circumstances rather than just repeating the applicable IFRS literature. And like I said, in IFRS, you have a practice statement. You can refer to it because that's also been amended to emphasize that entities should focus on providing accounting policy information, which is entity specific. So there are two examples. I mean, for the paucity of time, I will not be able to go into two examples, but there are two good examples in the practice statements which kind of address this. And if I was to very quickly try and summarize, let's just say you've got as a company, you've got PPE, you've got intangible assets, PPE, intangible assets, and goodwill. But let's say the company does not have any intangible assets, the company does not have any goodwill. Still, when you look at financial statements, when they draft, when you go through their accounting policies, it will give you the whole list of how intangibles are accounted for, or how goodwill is tested for impairment, or how PPE is tested for impairment. So let's say in the case of a company, like I said, there is no intangible asset, there is no goodwill, there was no impairment in the previous year. So effectively, you don't need accounting policy information on intangible. You don't need it on goodwill impairment and intangible impairment. When it comes to PPE, while you have PPE, let's say PPE is material to your financial statements. But because you've not had impairment in the current year or in the previous year, the principles of recognition and measurement of impairment may not really be relevant. But yes, because PPE is material, it may be important, or there may be significant judgment involved or assumptions involved in assessing whether or not there was impairment. So if there is none, then of course, I mean, the recognition measurement will come only later. But let's say if you've concluded that there is no impairment, the assumption or the judgments were applied more in testing whether or not there is impairment. So let's say those judgment and assumptions you have disclosed as part of your significant judgment or assumptions under Ind AS 1. So instead of giving an accounting policy separately, what you can do is just add, or how that assumption or what is the policy that you applied as far as assessing impairment was concerned, you can add it in the section on significant judgment or assumption itself. And you then don't really need to give the long list of, the whole thing on impairment, how is it assessed, how is it accounted, or how is it measured, and all those things. So that's just one example. There's some, like I said, it'll be useful to refer to the practice statement to get a sense of how this will really play out. Because the question is that, is this going to really lead to any significant change in terms of what we're doing currently? It can. It can impact the disclosures which are made by entities. Now, determining whether accounting policies are material or not will now require greater use of judgment. Companies will be required to revisit their accounting policy information to ensure that it's consistent, and the use of boilerplate disclosures, which has been observed in practice, is discouraged now. So that would just require some attention from the company. I know we're at 6, but I have one more and I'll try and be quick. The next one, if we can just go to the next one, please, which is on amendments to Ind AS 8, which is accounting estimates. Can we go to the next slide, please? There's actually quite a bit to speak here, but I'll try and be quick in the interest of time, since I don't see any questions on Q&A. So I guess we have 5 minutes. Now, again, here, the amendments to Ind AS 8 correspond to the amendments which have been made by IFRS to IAS 8. Now, why has this change been introduced? When you look at the standard has a definition of change in accounting estimate, but it doesn't define accounting. And then there is a definition of change in accounting policy. So effectively, what has happened is that the combination of the definition of one item, which is accounting policy, with the definition of a change in accounting estimate, which has not even been defined what an accounting estimate is, it has actually led to quite a bit of confusion. And usually, in terms of making a distinction between whether something's a change in accounting policy or something's a change in accounting estimate, that does at times become complex, and companies do face difficulties in making a distinction between the two. And therefore, what the amendments now do, they have deleted the definition of change in accounting estimate. Instead, the definition of accounting estimate itself has now been included. And there are certain clarifications relating to accounting estimate itself. So accounting estimate is now defined as monetary amounts in financial statements that are subject to measurement uncertainty. Very quickly, it is acknowledged that in accounting, when you have to arrive at an accounting estimate, an entity would need to use a measurement technique and inputs. Now, just because there is a change in measurement technique or inputs, which requires a change in a revision to your accounting estimate, does not necessarily mean there is an error. So I think through the guidance, they're also trying to make a distinction between what is a genuine change in estimate and what is a correction of error. So let's say if there is a change in measurement technique or inputs, which is not a correction of error, then it will be considered as a change in accounting estimate itself. Now, measurement techniques can include estimation techniques. For example, you may need an estimation technique for ECL, expected credit loss, or measurement technique can also involve a valuation technique, which is just to fair value for your asset and liability. Inputs are also needed, and I'll just explain why am I referring to these terms. Inputs are also needed at times when you're applying the measurement technique. So let's say if I have to measure the provision for warranty obligation, then there could be certain inputs which could be required as far as that estimation is concerned. Not all estimates will meet the definition of accounting estimates. Some could be just an input. So let's say if I'm making an estimate of volatility for determining my fair value of stock option, that volatility, which is an estimate, is not necessarily an accounting estimate, but it's more like an input to making the accounting estimates. So these are some of the clarifications that this brings out. Like I said earlier, just because there is a change in accounting estimate due to new information, new development, it does not mean that this is an correction of error. Again, while not in Ind AS, because Ind AS does not really carry forward the application guidance of IFRS, but if you were to go to IAS 8, IAS 8 has an application guidance section. It has included two examples, very simple examples. One is on fair value of investment property, and the other is on fair value of your stock option, to kind of explain how do you see whether something is a change in accounting policy or something is a change in accounting estimate. So very quickly, let's say under IFRS for investment property, you can do fair value of cost. So if I was on fair value, let's say under IFRS, I was on fair value of investment property, but earlier I was using an income approach under IFRS 13, and now I'm moving to a market approach under IFRS 13. This would be a change in accounting estimate and not a change in policy. Similarly, let's say I took the example of volatility, my expected volatility while measuring the fair value of my stock option. If there is a change in my expected volatility, provided it is not an error, then it will be a change in estimate, not a change in policy. So I think there's some good examples, two good examples in IAS 8, which you may refer to understand this better. Just to share one more point, which quite often gets discussed, is let's say in inventory valuation, when you're moving, let's say from weighted average to FIFO, something like that. Is this a change in accounting policy or a change in accounting estimate? I think that's well settled that this will be a change in policy. The IASB did consider whether to clarify this in the standard, but they finally decided not to. So, but I think some good, very interesting changes which have not been brought in. And as far as India is concerned, this is applicable for accounting periods beginning on or after 1st April 23. This will not apply retrospectively. This will be prospective. It will apply to any change in accounting estimate that you make in the first year in which it is applied. So any change in accounting estimate that you will be making in financial year 23-24, that is to which it will apply to. Sorry for the rushed one on this, but I thought this was an interesting one to just quickly cover. Utkarsh, I'm going to hand this back to you.
Thanks, Archana, for this. We have, kind of overshot our time, but thank you everyone for being part of this. If there are any questions, please do feel free to ask. We'll be on for a couple of minutes. If the Taxmann team can please read out, we don't see any questions in the box. If there are any, please do feel free to reach out and we'll be happy to address those.
While the participants are not asking any questions, while we're waiting, let me just share one more thing. When we were considering at least the supplier finance arrangements, etc., as part of finalization, we did feel there can be certain implementation challenges on which we've requested Institute to work on. So, for example, will it apply to purchase of PP, or let's say your group entity pays and then you pay to the group entity and so on. So there's still what would really fall within the scope of that financial institution and so on. You also at times have similar arrangements for PP, which you don't really, the question is, will that be considered as trade payable or whatever to which it will apply? I'm just sharing these so that you may want to think about whether there are any other implementation challenges that you can anticipate and where you think more guidance may be needed.